Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got an awesome show today. Been wanting to have this guest on for years. Brian Jacobs. Brian works at Aptus Capital Advisors alongside former podcast alum JD Gardner. Check out his old episode in the show notes. Today, Brian and I are going to debate all sorts of topics about the markets, discuss some of Aptus ETFs. Brian, welcome to the show.
Thanks so much for having me. Great to be here.
When I had JD on, he said he was also in LA, which meant Lower Alabama. Where do we find you today?
I'm in the Northwest. I'm in the Bay Area, California, but always got to mention I come by way of New York City.
There's probably no one else in the investing ecosystem that I've gone back and forth with over the years on all sorts of topics, bounce ideas off on just about anything. I actually tweeted out one of your charts today, or Aptus charts. I don't know if it's you specifically, but it's got your fingerprints on it.
Yeah, that was me.
You see some of these stats, and some of them stick out because they're so unbelievable is the wrong word, but if you were to poll people, you know, I love my polls. I feel like everyone would get it wrong. Can you tell us about your bond chart?
Sure. This kind of goes back to even broader asset allocation with our firm. It's the view that if you can allocate kind of away from fixed income and more to equity, but have similar risk, then you're probably better off. And the reason for that is in the chart, as it showed, a lot of people look at bond returns, bond yields, and say, hey, it might not maybe compensate for the risk taking, or better said, may not allow me to get where I need to be from a financial goal perspective. But it's usually viewed pre-inflation and almost always viewed pre-tax. And so if you look at bond returns long-term, so 100 years after inflation, after tax, you're looking at it roughly 0% total return. And I think that's something that would surprise a lot of investors. And if you can move away from that to something that can provide you positive after-tax real return, then you're probably better off as an investor.
I mean, let that sink in. A century of no returns. And forget about if you're an advisor where you lop on another 50, 100 basis points on top of that, those bonds. So my Morgan Stanley advisors that are listening to this, and you're an end client, and you're like, after inflation, after tax, after your fees, I'm probably losing money on this investment, or I have for the last 100 years. That's sort of a crazy takeaway. And then you look at it, so we'll put the link on YouTube and in the show notes, but it's a chart of the S&P, how much it's done over the past 100 years versus bonds.
Yeah, and even if you get to today, I mean, you think, let's say starting point 5%. Let's go there. If you think inflation, let's say it's 3, then you're looking at 2% real. And the big challenge with fixed income is you're not taxed long-term on your gains. You're taxed every single year on the yield at the short-term rate. So you're looking at a 33% or higher. We live in California, so call it 50% at the highest rate on the 5%, not on the 2% real. And so you quickly get to, even at current yield levels of 5%, which people are saying, finally, there's yield again in bonds, you're still looking at maybe a 0% real after-tax return.
You know, and on top of this, and I've been kind of preaching this for a while, but looking at a lot of the even riskier bonds. So you look at some of these other ones, like you're not getting compensated with a whole heck of a lot of yield relative to probably the risk you're taking. Because like if you think in your head, corporates or junk or 30-year, a lot more volatile than T-bills. And then you add on all these other considerations and it's, I don't know, man. Doesn't get me all hot and bothered. Better than zero, I guess.
No, we could talk high yield as well, but we've done analysis on that too. High yield historically has returned about 2.5-3% less than its starting yield, going back about 30, 40 years. The reason being, at the most you can do with bonds is capture the yield. When there are defaults, you start getting into trouble, you're going to capture less than the yield longer term. It varies. Sometimes if yields compress, all that stuff. But again, if you have a starting point where yields are very tight, like they are in high yield right now, you're not getting that much more incremental return from high yield compared to history. And so it's a real big challenge for investors going forward for sure.
Yeah, but everyone keeps hoovering them up, particularly the liability driven, maybe people that say, hey, man, I can lock in this 5-6%. And they do, but it doesn't create the opportunity, at least for them to be the normal spreads. Anyway, we'll see. Who knows what happens? But in a similar vein, you have a similar chart, which I love. I come to a somewhat almost different conclusion at the end of it, I think. But you've also demonstrated that China stock market has had like no returns for like 30 years or something, or inception.
I'm trying to think when that, I think at this point, if we did a snapshot of today, I think it's back to positive. I think it was probably within the last year or so, from the 1992 inception of the MSCI China index through, call it 2 years ago, the total return of that index was zero. And that's, again, that's something that investors need to weigh. I know you and I have had a lot of back and forth about US versus global allocations. And one thing with China is the companies are great. We have, obviously, we're right in the middle of DeepSeek and what could happen there from kind of the technology side of things. But from a shareholder perspective, it has not been a very good place to be for a long time.
Give us an update on Aptus. So you guys are up to what, about a dozen ETFs?
8 ETFs as of this moment, not likely to be 9 in the next few months.
And $4 billion in assets. Congratulations. That's awesome.
Thank you. Yeah, we had a really strong 2024. A lot of our products resonated. It was very exciting.
For the listeners who didn't listen to the Gardner episode, give us just like kind of the quick background, because you guys are a little different as far as what y'all do. A little overview of the firm in general, kind of how y'all think about the world.
Sure. Yeah, of the 8 ETFs that are out, 7 are options oriented. So include options in one way or another. Some of them have for downside protection, so puts. Some of them have covered calls for income. But what we're really trying to do is provide products that can really kind of change the return results of a broader allocation, really move the needle. We started off this conversation with our view on bonds. If bonds aren't able to generate a positive real after-tax return, but are there for the cushioning, is there a better way to cushion? And that's where we think options really can come in place. So as a firm, our flagship product is a hedged equity product. It's ACIO, and that's a product that is now north of $1.5 billion. It's very similar in kind of theory as some of the buffered products that are out there in the marketplace, willing to give up a little bit of upside to protect more of the downside, but we're very active in our approach.
And so you guys own stocks, and when you say protect the downside, what do you guys actually do? Are you selling calls, buying puts?
Yeah, so our starting point is, let's say we have the equity basket, and then we're buying protection, so buying puts at about 5% down at a starting point. And then how much of the upside we have to give away, so how much of the calls we're selling, is going to be a function of a number of things. It's going to be a number of market volatility, how expensive are those puts, for example. And then we're going to be selling those calls on individual names within the portfolio. So a lot of the buffered strategies that are similar in nature have an equity position, then are selling calls on the broader market and buying puts on the broader market. By selling calls on individual securities, they have higher volatility on each individual one because an individual stock has more volatility than a broader index. And if we can sell it on the correct names, we think we can capture more income so that we can push the downside protection closer to the current levels of the broader market. And so compared to a buffered strategy, our goal, again, it's a goal, it's not an explicit thing that we can do year in, year out, is to provide better protection closer to kind of current price and give away less of the upside than the market. Last year's a good example. Volatility in the market starting in late 2023 through 2024 was pretty low. And so the cost of buying puts was much cheaper than if volatility was higher. And as a result, we didn't have to sell away nearly as much of the upside away. And so we were able to capture much more of a percent of the capture of the S&P 500 last year than a lot of the buffered competitors that we see year to day in, day out.
When does this kind of shine the most, and when does it struggle?
The question is always going to be absolute or relative, right? Absolute, it's going to do best when stock markets do well. It's never going to be short the market. So if markets are up, it's going to do better. On a relative basis, it'll do well if markets, let's say, are sharply off, because then it has the put protections in place relative to a broader equity allocation. And if markets are slowly trending higher, so it's not going through the caps that we have on the individual stocks, then we think we can keep up with the market pretty well. Where we're going to underperform is if markets just move very sharply up and to the right, then you're going to be capped out of some of the names and you won't keep up with the broader market.
For your second biggest fund, de-risk, what's the defined risk all about? Similar or different?
Very different. So whereas the hedged equity product is a way, you're giving away upside of the equity market because you're selling the calls on the individual securities, de-risk is a fixed income alternative that allows us to incorporate additional equity exposure into the product. And so whereas if you swap out the ACIO product 1-for-1 from S&P 500 ACIO, you're de-risking probably the portfolio. If you put de-risk as a replacement for, let's say, a traditional ag bond exposure, we think you're going to be increasing your equity profile. But we're doing it through calls, but we're actually long calls on the market. And so taking a step back, the product holds laddered intermediate investment grade corporate bonds through ETFs. And then we're layering on calls to capture upside of the equity market and puts, long puts to capture downside protection. And so that's a product that if you think about how it would compare to let's say a traditional bond portfolio, if the equity markets are flat, you've bought calls, you've bought puts at a premium that costs money, you're going to underperform the broader fixed income market. If markets move sharply higher, you're going to capture equity exposure because the calls are going to be in the money. And if equity markets are sharply off, that's where the puts can kick in and you could outperform the traditional bond portfolio on the downside.
And the puts are on stocks or on the corporates?
Yeah, so the options are all on equity market. So it's S&P 500 on the puts, and then we do have individual names that are long on the calls.
Where does this one fit in when you're talking about the allocation model?
We think it's a way just for clients that can't shift their allocation, but want to take on more incremental equity exposure, but do it in an option manner so their downside is capped. We think it's a really nice way just to slot it in one for a fixed income allocation. Blended in with, this is where we think it really fits well. When we blend ACIO, the hedged equity product, with de-risk, the combination between the two gets really interesting for clients.
What does that mean? What does it look like? Does it end up looking like almost like a complete portfolio?
What it ends up looking like is you have the downside protected through both products. Again, I have to explain protected, meaning we have puts in place. So if equity markets are off, the puts will pay off in both products. And then the de-risk long call options helps to offset some of what you're giving up with the ACIO product where you're capping the upside. And so it's a product that we think really fits in well with kind of an easy way we call it a Trojan horse to get more equity exposure into a broader portfolio. But again, we do it through the use of options. So it doesn't, like a fixed income allocation, you don't want to be off 30, 40% with equity exposure. So this is going to be capped at just the premiums that you're paying to get the exposure for the puts and calls.
UPSD, this is the new one for you guys. Upside, not too far away from PTSD, but what's this one?
That's my baby. So that's the one that I'm portfolio manager on. And that idea has been kicking around in my head for a decade plus. So
I think I had some previews to this one before it eventually got birthed to the world, but tell us about it.
Yeah, absolutely. So at a starting point, it's an equity alternative. Its starting place is a minimum volatility portfolio of US equity stocks. And so if you think about what the goal of that is, it's to capture equity market exposure, but have lower volatility over time. And so we found from just a backtesting standpoint, that's been about a 25, 30% lower standard deviation product than the broader equity market.
Just to interrupt you, we'll put this in the show notes. One of my favorite pieces of the past couple of years, listeners may have heard of this, but it was Robeco's conservative investing, which does the low vol approach. And the cool part is you can now go download that data set. Certainly for the 1900s, it may even, like in the book, it goes back into the 1800s, but it's a pretty cool examination. And Pim wrote a book on this with a slightly different name. But if you just Google, we'll put it in the show notes, but if you Google conservative investing and Robeco, you can download these data sets and really dig in for really long periods. Pretty awesome. And they've got like 15 different series. Anyway, continue on.
No, I think the main goal there is, again, volatility management. But a key feature of minimum volatility stocks historically is that they have had very similar returns as the broader equity market. So you're not necessarily giving up returns for a lower risk solution. One challenge of lower volatility or minimum volatility stocks is they do tend to be concentrated in specific areas of the market. And so to counter that, that product has a multi-factor screen where we're looking for growth, quality, valuation, et cetera, to have a more balanced portfolio. And we have a lot of things in place to minimize the variance between that and the broader market from certain kind of risk characteristics. If we could match the S&P 500, that'd be a huge win. But our real goal is to have much lower risk. What that does in our view is create an opportunity to take more risk elsewhere. And this goes back to kind of something that you and I have discussed. I think I came across you 15 plus years ago with your initial paper on trend following. I've been a huge proponent of that since you and I have always discussed, kind of after reading that, you and I have discussed a lot of the aspects of that. What we're then doing within the minimum volatility portfolio is overlaying on top of that trend following. And we're doing that in a number of different ways. The combined profile of the product is something that in an uptrending market, we think will have more risk than the broader market. And then in a downtrending market, because it will be left with basically just the minimum volatility core as the majority of its holdings, should be less risky than the broader market. And the key aspect of that, it goes back to what are some key benefits of trend following and what are the key risks of trend following? The key benefits are pretty clear. Historically, you've been able to avoid massive drawdowns from trend following. You have, again, your paper, anybody could point to anything that you've done in the paper and you can see that clearly. The real challenge of trend following, which we found over the past, especially 10 years in an up market, is clients that are not long or go long cash get in and out at the absolute wrong time. There is a big tracking error between trend following and just being exposed to the equity market. And so clients, whether they say they think they can or not, they have a hard time sticking with it. And so what we think the combined solution does is by shifting everything kind of up towards the equity market as its base, and then being able to overweight or underweight based on trend, we think could be a product that can add more incremental return, can outperform in an up market, but then a client could stick with it better because the tracking error or the variance between it in the market and up and down market is going to be narrower.
I speak to a lot of advisors over the years, and we think a lot about the behavioral and psychological side of all these type of strategies, buy and hold, stocks, bonds, whatever, adding gold. But with trends specifically, if you're an advisor, and there's still some out there that do this, that say, hey, I'm going to trade my book, but I'm going to sell these ETFs, these stocks when they go below their long-term trend, and I'll get back in when they're above. And I say, look, that's totally reasonable strategy, but that is a very, very difficult in-client strategy, because what the end client sees is one, trades happening. And second is they expect you to be right, and not even like 50-50 right, probably like 80% right on, getting in and out. And so I think from a behavioral standpoint, it's really hard to implement that. And so we've always said it's easier to actually buy a fund that does it within it, because the client doesn't see the actual batting average, which often can be low, doesn't see the consistent whipsaws, et cetera. And also it removes some of the behavioral seductions of, oh man, it's 2007 and REITs are rolling over. I'm not ready to sell them yet. I'm just going to wait a month. Or I'm going to ignore this signal, but I'll take the next one. Or ditto on the upside. We're like, bro, 2020, this is like vampire zombie apocalypse is happening. This thing is going down to like single digit PEs. Like, there's no way I'm buying back into this. And so people, when they're like, well, you know what, instead of using the 50-day, I'm going to use the 200-day this time. It's like a diet. Like, everyone rationalizes their behavior and it's got to be like a 99% hit rate on people making the wrong decision anytime they do this. And so I think it's really challenging from an emotional standpoint. How do most investors use upside?
Yeah, so the starting point from our model perspective is we're using it within our most aggressive allocations. Really, the hole that is filled within our product lineup is we did not have any products that could keep up with the equity market in a complete uptape. We didn't have any products that were 100% market capture, for example. This is a product that really fits that more the growth and aggressive, so more equity heavy portfolios, because it allows us to have the asymmetry potential of returns within the line item. We still have more than 100% potential up capture, still have less than 100% potential down capture. And so that's where we're seeing it as a pure equity kind of swap, like swapping out equities for this product.
Can you guys give us a peek to this next fund you have coming out?
Yeah, no, we're filed and hoping to launch in February. So that is ticker DEFR, defer. And so you could probably guess where that's coming from. But our initial conversation started today based on fixed income and the challenges. Challenge number one is a return problem. Historically, they have not provided the return that people needed, even pre-tax. And if you look at the AG index, so the Bloomberg AG index incepted in 1976. All right, this is trivia for you. Similar duration treasury portfolio. So let's say every single day it traded at the same duration as the AG index. How much more did the AG index outperform that treasury index since 1976?
So the AG index is comprised, what is it like? It's not 25% each of treasury, corporate, mortgage-backed.
It's got some agencies in there. And that weight has fluctuated over time. So at certain points, it's had more corporates. Right now, I think it's about 20%.
0.5%, if anything.
So 0.3% per year, incremental return by taking on more risk. That's a good job. That's a good job. You're pretty close.
What's your point, though? Where are you going with this?
So that's the return problem with the ag. You're not getting that much more than treasuries, which we already talked about not being able to keep up. And then number two is the tax impact. So it's almost roughly 100% of the return over time is driven by coupon, not by price fluctuation. Some years it's more price, some years it's less, but over the long term, it's basically coupon is your return. And coupon's taxed to the short-term rate. And so you have a return problem and a tax problem. And so what DEFR is trying to target is both. One, we're trying to outperform, and we can get into how we're trying to do that. And then number two is we create a structure that we think can defer majority of the returns over time. And so it's not going to be paying out the coupons at a short-term rate, where you're going to get taxed at a short-term rate. So you can compound your returns at a much higher rate over time. That's the product. In terms of how we're doing it,
yeah, you got to give the big reveal now. What's his magic?
So over time, we're going to be roughly the same duration as the ag. So we're replicating that through treasuries. And so we're going to be roughly 75 to 125% the duration of the index within treasuries. So think of the duration component as being the same. So you mentioned earlier, 0.3% was the answer. How much did it outperform treasuries? We're starting with that treasury component. What that means is we need to outperform historically by 0.3% a year. If we had done that since 1976, we would have an outperformance within our strategy. We're doing that by overlaying on top of that put writing that's dynamic in nature at a level that is comparable to the risk profile of the spread component of the ag.
Put writing on what? Stocks?
On the S&P 500.
Yeah.
Because what you actually see is credit spreads and put writing are extraordinarily correlated. They are both very correlated to the equity markets as well. And if you scale it at a similar risk profile as one another, so to say, historically, the spread of the ag, if you just isolated it, has been about 2% risk a year. Call it that. If you create a solution of put writing that is roughly 2% risk over time, it outperforms pretty easily compared to the 0.3%. What we're doing differently, though, is we're not just discriminately selling puts every single month or every single day. What we're doing is looking at a few signals to determine whether the risk profile of the market warrants selling puts. And so we're doing that to say at certain points when it's saying it's favorable from a risk-adjusted standpoint to sell puts, we're selling puts. Otherwise, we're not writing on anything, and the portfolio is going to look and feel like a treasury portfolio. So that's the structure itself. The signals themselves are much shorter term in nature than, let's say, a traditional trend following, but it's going to be using signals that are out there in the marketplace from the VIX.
So magic, options magic. I like it. That's interesting. You alluded to something. I think most listeners would assume that the ideal time to be doing put writing on the S&P is if the VIX is at 40 or something. I feel like you've written about this and the conclusion was somewhat different without giving away all the goodies. How should people think about, like, when are the good times to be thinking about writing or getting income from puts?
All right, I'm terrible with analogies, but I'll try to make some. It's always good to insure a good driver. So if volatility levels are low, the chances of the market crashing are lower historically. So some of the best risk-adjusted performance of writing puts is when the VIX is very, very low.
I feel like that's very counterintuitive for most listeners.
But a key that I mentioned there was risk-adjusted. The key there is it's very low risk, not necessarily all that high return. The best time to be writing puts on the market from a return standpoint are when volatility is high, but when volatility is trending lower. So what you don't want to do is be selling puts historically when volatility is rising. When it's rising, you absolutely do not want to be selling puts. But once volatility is kind of spiked and kind of trending back down, historically, that has been a very good time to be selling puts over the next month. Again, you're not guaranteed anything. High volatility environment is absolutely a much riskier environment, but it has historically been a higher return environment when volatility is trending lower. So that's the key part of when to sell. You mentioned, the intuitive thing would be to sell when it's 40. That's actually not far off if it had been 60 like the month prior.
It's interesting because, like, I feel like a lot of time you talk to shops and they have like one very specific, like we write covered calls, or, we use puts, long or short, whatever it is. You guys are on every which possible side of this, right? Let's say I think it's a really open-minded approach to options because, most people are like, no, I'm an option seller. I never buy options. It's a waste of money. But you guys have every possible iteration of this, I think.
Yeah, I mean, the key also is to be able to take advantage of market opportunities. We have very few products that it's saying every single month, no matter what, you're going to be selling calls. We really don't have that. It's really going to be determined by what we feel is the market opportunity for it. And so if the market, again, I go back, this is from 20, 30 minutes ago, our hedged equity product, ACIO. It's a product that in most instances will sell calls to pay for the puts. But if the puts are super cheap and volatility is super low, we're not going to, why would we sell away upside when we don't need it? So it's really the dynamic nature that is the most consistent part of our process.
If you look back through history, and the quant nerds and people on Twitter love the scatter plots, and we look at, say, for example, bond yields versus future returns, and it's like pretty high R squared, pretty high correlation of like where you're buying these and like where you end up. I mean, it's not as high and as amazing as the CAPE ratio, but it's up there, right? I figured we had to wait 50 minutes to trigger Brian on our one main disagreement. But if you look at the bonds, but it's interesting because it's true with corporate bonds, but it's also true with the spread relative to T-bills. But if you look at the corporate spreads historically, it's also, they have a pretty high correlation to the VIX. It's like an interesting kind of somewhat similar. I mean, look, it's kind of obvious when everything's hitting the fan and like an 08, 09, spreads blow out. And generally the VIX blows out too. It's an interesting sort of commingled co-correlation.
That was actually data that I wanted to put into our deck. And CBOE used to publish every single month what the premium would be on an at-the-money put. And so historically, if you look back, I think I had the data when I ran it from call it 1990 through 2012. And it was like, you mapped them and they literally looked like the same chart. Replacing credit spread with put writing isn't that crazy an idea from a correlation standpoint, but they stopped publishing it and they refused to send it to me. So I don't have that information anymore.
Talk to me after this. We got a lot of friends over there.
I had a blog post recently also about, I am not a proponent of high yield. To me, it's an asset class that just doesn't make sense. With treasuries and equities blended at different rates, you can get the same risk with much better return. Going back to replacing credit spread with something maybe that isn't as driven by insurance companies or LDI, where the buyers are agnostic about price, might get you to a better result. That's what we're trying to do with our DEFR product.
And you do a lot of great blog posts, which is on the Aptus website now with a lot of hot takes. But one of your best calls ever, I think, was you're just like, look, if you're not taking out a mortgage right now, you don't even want to buy a house, go buy a house. Like, it does not get any better than this right now. Was that the summary of your idea? What were you saying back then?
This is going to be kind of a preview. I was going to maybe have this as my most memorable investment.
Too bad. Now you're going to have to name two.
And now I got to name another one. But when I bought a house in 2018, I was an anti-homeowner for a long time because I personally just like optionality in my life. And I was like, I don't want to do that. Then I had 3 kids and kind of the optionality was already gone. But I bought a house and I was like, I can't believe I'm paying this much money for it. And I bought close to 5% rate. And then within a 3-year period, it was down to 2.5. And I remember I couldn't believe it was 2.5. And then maybe 6 months later, inflation had already started moving higher and you could still get a mortgage for 2.5. And at the same time on Twitter, there were so many people saying, you should still pay down your mortgage. And it was just triggering event for me. And so that's where I was like, if people were asking, what is the best inflation hedge out there right now? And I said, a 30-year mortgage at 2.5% is the best inflation hedge you can have.
Yeah. Except for 2. You might as well get 2.
If you can get 2. I didn't get 2. I got 2.5, which I'm never moving.
No, I mean, get 2 mortgages.
Oh, 2 mortgages.
It'd be like the strippers in The Big Short. They're just loaded up on one after another. But you wrote some other stuff about housing recently too. What were you talking about recently? About affordability?
To me, that post was, again, this is not a non-California thing, but a lot of it goes down to the arguments that I see on a daily basis tend to be more on Twitter. That's how I interact with more people these days about investment topics. And whenever it's the comparison of how has home ownership compared to other asset classes, the thing that's always missed is the income aspect of home ownership, even if you don't rent it out. Because what you're doing as a homeowner is not paying rent. And so just even calculating correctly, is it better to own versus rent? You need to have all the cash flows in place. And it's always missing the cash flows. It's always, I paid this much money for a house and I sold it at this much money. It was a good or bad investment. The key is not that. The key is over the life of home ownership compared to life of renting, which one is going to be paying more in cash? And that's assuming a house is only an investment. That's not the consumption side of it.
And it depends. If you don't buy the house, you keep the money in cash and you buy fart coin, or you buy bonds that you pay, all these taxes. Like, people forget all the line items. I feel like it's like, what's the opportunity cost? My hot take on the housing part, and we'll let you continue, is the reason that housing is such a good investment over time is most of us would spend that money otherwise, right? Like, you got $100,000 sitting in a bank account. You think you're going to go invest all that? Like, probably not. Like, you're going to go buy some boat or some Ford F-150. Like, I feel like it's just like forced savings, and that's why it's
forced savings and not getting out of the investment at the wrong time, all those things. And extraordinarily, I mean, our entire tax code is written by people who are homeowners. So everything about homeownership is tax favorable. And so all those things combine to just making it that the bet is not as obvious as it might otherwise be. And even home valuations, if you look at it compared to income, it's not as bad as you might otherwise think. Although, again, compared to what it was like 2 years ago when rates were 2.5, it's not comparable. I think people maybe are comparing it to the recency of how cheap housing was with a 2.5% mortgage, and not looking back to the, call it 90s or especially the 80s, to say when rates were much higher, even if the home prices were very low, like the comment, my parents bought that house for only $50,000, but they had $10,000 a year or less in income, and they had a 15% mortgage. And so that post is really just to kind of set the stage to say, not that housing was necessarily cheap, but that it's not viewed through the right lens.
I'm surprised you have the academic literature, and there's so much about historical stock returns, historical bond returns. There's not nearly as much about, and it's hard. The reason why is it's hard and it changes over time throughout history. And there's a lot of assumptions on tax rates, but like something like the bonds, which you're talking about, that's a very different return stream in a tax deferred account than in a taxable account. It's also very different in California than in Iowa. It's also very different in California now than 50 years ago. So it's hard to model all these things. I think you're seeing a revolution in tax optimized strategies and ideas. We talk about 351. You talked about defer, talk about the stuff Wes is doing. All these ideas, I think you're going to see a huge shift in the next 5 years about location, where to put investments, how to think about them. But I'm surprised there's not, like, a Wyndham used to do this, like some of these online optimizers and calculators. I get that it gets too hard pretty quick, but it's interesting to me, like maybe AI fixes this. I don't know. But the assumptions obviously change so much about it. But I think you'll see a lot more popularity and development here.
No, even to that point, I've had conversations with people about what's the best place to put bonds if you're going to own them, if you have a specific overall allocation, and there's no correct answer. Because you could say bonds, of course, they should be in a qualified account so you don't pay taxes, but that's likely an account that you're not going to touch for 30, 40 years. You really need fixed income in that. And so those kind of questions make that very challenging. What you do know is that if you can get similar exposure, you want it as tax efficient as possible. That's the part that's the easy part.
All right, let's do some PTI style topics. The first one being investment truisms. We did a paper a while back called The Investing Pyramid, which was looking at a humorous look at sort of the food pyramid of our youth, which was, hey, Brian and Meb, go make yourself a bowl of Fruit Loops, Frosted Flakes. You want to make sure you have 12 servings a day of pasta, bread, cereal, sugars, right? And at the very top is like, you don't want to eat any meat, like type of things. And essentially it's almost flipped to today. But, we made a lot of analogies, like what would a broker from E.F. Hutton or Dean Witter say in the 80s, buy some blue chip stocks, on and on, and versus like, what would people say today? But the base of my pyramid has been the decision to save and invest in the first place trumps everything else. Like, that is far more impactful than actually what you invest in. Just like, you need to put the money to work. And it's like the classic thing that a lot of kids see in elementary school and high school, and it's a little abstract for them because they just see the compounding. Hey, if you just have $1,000 now, you have 10 trillion by the time, you retire. But you have to have that money and you have to put it to work. And I think that's probably not that hot of a take. but I think it's actually way more outsized relative to the amount of time that we spend talking about other topics, whatever it may be.
I agree with that. Where do you sit on it's more important to earn a higher income than to try to save a bigger percent?
You and I are getting old enough to where I feel like it's like old man shouting. It's like, we did this old post, we did this old article, but I was like, we did this old one called, it was like the best way to add, because people love talking about income and yield. So what's the best way to add income or yield to your portfolio? And then we walked through and said, how much do you value your time at, Brian Mebs? You have a job. Doesn't matter if you're picking up trash, doesn't matter if you're a lawyer, but you make something over probably $15 an hour. And then how much time are you spending on Reddit, Twitter, whatever? And this is mainly targeted to the non-professionals out there. So you have a real job. And how much is that alpha quest costing you? Now, like, ignore the fact that you just love it as a hobby. You're interested in investing, but you think you're going to like add some value picking funds or picking stocks. And then how much alpha would you have to make versus the time you spend that would be better spent working overtime, getting a second job, driving Uber and listening to podcasts like this one, or, doing different ideas. So you're not focused on this alpha quest. And it's like, the takeaway is obvious. Like, you should just automate your portfolio, buy some Aptus and Cambria funds, and go spend time trying to get a raise or get a second degree or learn some AI. Like, I think you should automate your public market portfolio to the greatest extent possible.
I think taxes and limiting taxes is as or more important than active management of your investments.
There's a reason our buddy lives in Puerto Rico, like that having been said, you and I do agree on one point, which is we still live in California. So we're not totally tax optimized.
No, we're definitely not. But the amount of time I spend on that, actually, I find it more interesting every year too, which shows you how old I'm getting, is that conversations about taxes and different ways to kind of structure things has become almost more interesting to me than the investment side itself, which is definitely a sign of my age.
Well, I did a tax tweet the other day where I was like,
the one I mentioned was taking out a loan against your equities so you never have to sell, then you could step up at death. Like, those are some examples of some things where the very wealthy can do that. People that need to spend down their investments can't. And it just doesn't logically make sense to me. But again, if it's there and it's available, I'm going to do everything I can to capture those things. So I'll speak out so close out of my mouth.
All right, I got one for you. You and I have talked a lot about stock buybacks. So this is kind of tangential to tax efficiency. You also wrote about somewhere that buybacks don't matter in the aggregate. What do you mean by that?
So the common statement of buybacks is that the companies should only buy back stock when it's cheap. My view is companies should, if they're otherwise wanting to pay a distribution to shareholders, they should pay it through a buyback, irrespective of the price of the stock. The reason being is that if they buy back stock at a discount, it's better for shareholders that stay, but worse for shareholders that leave. And if the stock is too expensive, it just flips that. It just says that's better for shareholders that leave and worse for those that stay. Aggregate together, it's a net wash. It doesn't matter in aggregate to starting shareholders of what they do, because it's better for one side than the other. And in my view is if the stock's expensive, no, that's great. For those that determine that it's expensive and agree with them, they're going to be the ones selling their stock to the buyback. And so that's where that kind of all came about.
I'm always curious, though, is like, who's the person that owns it, doesn't want to own it, and sells in the buyback? Like, why do you own it in the first place? Like, why don't you just sell it?
I've said this all on too. It's like, if you think the stock's too expensive, then you should probably be selling anyway, right? If you're willing to make an active decision and you're willing to sell to a buyback, it shouldn't matter the price if you think it's expensive.
That's always like the classic when people say there's more buyers than sellers. You're like, no, there's always a buyer and seller. And that's the great thing about markets is like both of them think they're right. It's like someone somewhere, but it's a weird setup for me. I'm always thinking about that. I'm like, I agree with you. My favorite chart, I don't think most know the dividend is essentially a return of capital and the stock price drops. All right, so this is from honestmath.com. And it's like the best visual of this. Anyway, we'll post in the show note links and put it on YouTube. But I actually don't think that people realize that's what's happening. Do you?
I don't know.
You have a higher opinion of investors' intelligence than I do.
I mean, I've seen enough people say that bonds have returned like negative over time because they just show the price return of bonds. So, I mean, there's plenty of people I'm sure that think that. I mean, it is true that when the gains are all embedded within the price rather than distributed back into a total return, whether that is actually positive for behavior because they see a bigger dollar amount in their bank account. I know there's the tax benefit, but it would be interesting to me if there's a behavioral benefit as well of them seeing more of the gain.
They go mistakenly chart it on like some like non-total return websites. They're like, oh my God, this thing is amazing, right? This thing just beats everything. Because
I mean, that's a win, or that's a win for you.
yeah, that's interesting. Never thought about that.
That's what you should do. You should say, hey, I believe in price returns. I don't believe in total returns.
That would be a good troll. Be like, why do you guys look at total returns? You should be looking at price returns only. That's like a Joe Weisenthal tweet. It's just like a very clever but quiet, like it sounds like it's almost right, but it's really like the smartest troll ever.
Half the time I read his tweets and I'm like about to react to it. Then I see who it's from. I'm like, okay, got it.
Yeah, 100%. Do you got any more PTIs for me?
My take is you should not even consider buying a home or a condo if you have any intention of moving within a 7-year period.
For someone who just sold the last of his farmland, real estate ownership is always my worst nightmare. But speaking specifically to someone else's real estate, like I look at people that own and lease apartments, Airbnbs, and I'm just like, what a nightmare. That's my version of hell. When I kick the bucket, go to the pearly gates, whatever, and they're like, actually, Mav, you're going down south. You're now like a landlord. So personal ownership, slightly different. Again, it's like your own kid versus someone else's crying baby.
All right, I'll rephrase it then. Do you believe in the starter home? Somebody buying a house that they can't build larger in the future, but they know they'll outgrow in a, call it 5 to 7 year time frame.
I feel like this is a topic that I actually don't have a strong opinion on.
To me, the biggest thing, though, is the behavioral side of it. I have friends who bought starter homes. And now with the rates going higher, I can't tell if they're happy or not. They're happy they have a house at a cheap rate, but they're forever not going to live in the type of house that they prefer to live over a 30-year period. So that's kind of where that came from.
Hopping back to the tax, I just remembered, like, think about these like little things that matter. The amount of professional investors I've spoken to, they're talking about like, oh, we do these like customized SMAs, or we'll do these like direct indexing. And I'll be like, well, the nice thing about the ETF is the management fee is essentially tax deductible. So if you're going to compare apples to oranges, the ETF fee is like on a taxable basis, like much lower, relatively speaking, to this separate account. I would say like 5% of professional investors, maybe 10% understand that comment or were aware of that. So that's another interesting one where taxes matter, but like it's the headline, like it's the expense ratio. I mean, you and I have talked about, oh my God, some of these, there's the product design and then there's the implementation. And one of like, I feel like both of our funny bones is seeing some of these funds, they get 10, 50 billion, and they just ignore the entire like implementation of the strategy and end up owning 10, 20% of the stocks. And then it's like, just absolutely nuke their funds. Do you have anything pleasant to add on that topic?
No, without naming names, I don't even know what they're supposed to do. You have a $10 billion ETF that is supposed to own like small caps and micro caps.
No, there's a lot you can do. So let's say theoretically you're an index fund and you're targeting small caps and you buy 100 stocks, you rebalance it once a quarter till the cows come home, right?
That's what we did there.
That's as good of a hint as I can get. So, and then you grow to 10 billion. But you're just like, we just follow the index. That's what we do. We're just going to YOLO in and out. So be it. You get the index returns. That's what it's going to be. Well, this is a benefit of being an active manager or someone who's willing to change the prospectus and upset the apple cart. You could say, we're going to do what Brian and team does at Aptus. So instead of rebalancing once a quarter, we could rebalance once a week and it'd be 1/52nd of the portfolio. Or we could do it once every day. And so every day it's like a different rebal. So at least chops it up into pieces and it may be totally different stocks. You can move from 100 to 150. You can move from 150 to 200. You can move to 500. Now, it's going to probably slightly dilute your exposure and returns, but relative to YOLOing into 20% of the float, it's not even the same universe.
Oh, no, it's a much better outcome. The question that I would always have, if you had a conversation with your client and said, hey, we're too big, we're changing our strategy, that's the conversation they don't want to have. That's why they're not doing it. I mean, right?
Well, I think what you need to do ahead of time is say, look, like we have plans for this. Like you're an ETF manager, like you need to plan for the good times too.
I'll add to the investment truism. You should not, I mean, this isn't probably a surprise based on what I said earlier. You should not strategically own credit. Is that a hot take? So strategically means you should not have a permanent line item. You should only allocate to credit after things blow up and there's an opportunity.
Yeah, I think that's good. I agree with you on that. I mean, like there's so many assets that we did a fun modeling sometimes where we'll look at stuff and we're like, hey, there's only data on this back to like the 70s. I would love to take this back to the 20s. Is there anything where we can like smash a few pieces of the recipe together and come up with the same exposure? And sometimes it's in the academic literature and often it's not us inventing it ourselves. There was one for REITs. And REITs, you can go to NAREIT and they have returns going back to, I think, the 1970s. Really good website and data. But you're like, man, I'd love to be able to really kind of figure out REITs back to the 20s. And it turns out you could do small cap value, French Fama real estate stocks, and AAA corporate bonds. And you basically end up with REITs. And so like there's some people out there that be like, REITs aren't a separate asset class because you're getting essentially stocks, corporates, and value tilts. Our old buddy Ladina used to talk about the Yale endowment. And he's like, actually, you know, you could factor-based decompress this into various exposures and on. Venture capital, PE. The company that I was maligning a second ago actually has a really interesting old index on PE VC replication coming out. I'm really curious to see how they implement it, but it's the same theory. It's being like, well, is it the returns of PE and VC just small cap quality with sector exposures? Is the US really as cheap as it is if you don't sector expose, Brian? Or is it just the CAPE ratio, just a crystal ball? I don't know, one of those. But so corporates, I think, is the same thing. It's just like stocks, bonds mashed together. So you kind of already have it. This is like the easiest question in the world for you. I don't know of anyone, maybe Cliff, who comes on the show and be like, all right, you sit down at a table, you got a belief that 75% of people would disagree with you on. I feel like that's like a majority of your beliefs, maybe. Same with some others, same with me. Like you got a lot of hot takes. What's one that's particularly be interesting, surprising?
Oh, it's not surprising to you, but it's time to mention it because probably our number one disagreement is that I think the CAPE ratio makes no logical sense.
Oh, no logical sense. All right, let's hear it. Why?
All right. So the CAPE ratio, the C stands for cyclical. So it is meant to cyclically adjust earnings for a price multiple. It was created a long time ago and gets, to me, nothing but favorable press and admiration because it's in theory predicted when returns are higher or lower based on starting levels. But if you actually project out based on when it was first published, the results, it's been off every single year over rolling 10-year timeframes by anywhere from 5 to 10+% on forward projected returns. They have been directionally right, but they've been off by such a magnitude that anybody using it for advice probably allocated at the wrong time, with the exception of the bubble. And a lot of signals were pointing to a bubble at that period of time. To me, the number one flaw is it uses EPS. So it doesn't adjust for things like buybacks that we talked about. So if a company buys back stock rather than issuing a dividend, the CAPE ratio is materially higher than if they had just issued a dividend. And it doesn't account for non-cyclical growth. And so the easy kind of data point for that is if you're looking at the CAPE and saying, man, it's expensive right now, then you're ignoring the fact that 10 years ago, one of the inputs for I should take a step back, the earnings that it uses are over the course of 10 years adjusted for inflation and uses the current price. The current price uses NVIDIA as one example at its current large weight, but it uses earnings in the calculation from 10 years ago when they were a fraction. And I'm talking about like 1,000th of what they currently earn. And so unless you think that the earnings of all these technology companies are going to revert back to where they maybe were 10 years ago, it's going to overstate valuations. And the thing that I do want to point out is that I don't necessarily disagree with the sentiment that there are a lot of companies that are maybe expensive, but if you're using the CAPE to make a valuation call, especially relative to other markets that haven't grown, and we've already talked about growth feeds into EPS and buybacks feed into EPS, which are US-centric attributes of companies, then I don't think it's a valuable metric to compare markets. That's my soapbox statement.
what valuation metric do you find to be valuable, or are there none on a market-wide basis?
If I was to use just one, I would say just use forward PE. If you just want to do something plain vanilla, it's going to miss turning points because people don't necessarily adjust earnings projections, and oftentimes they come in lower. But if you look at that, especially in the case of different segments of the US market, it's been, to me, very predictive of kind of where things are headed. Specifically, even within small caps, if you exclude like non-earners, it's actually done a really good job.
My hot take, I actually don't think it matters which one you use for the most part. Like if it's 1999 or 2009 or 1982, on average, usually they all say the same thing in my belief. Different degrees, different magnitudes. I think the challenge with the media is they love talking about the different ones and never often acknowledge that they're talking about different ones. So they'll just say PE ratio. I'm like, well, hold on, like which one are you talking about? But I actually don't even think the earnings one matters. Like we track 10-year price to cash flow, price to book, price to sales, price to dividends, on and on. And usually they kind of end up in the same part of the universe. But the bigger question that I long think about, and I love thinking about the extremes. To me, bubble territory is not till you get above 40. And blood on the streets is like not till you get below 10. But when you get to these extremes is like where all the interesting stuff happens. And I think like we ran a historical database on capes. And again, obviously, when you're talking about something like Denmark, it's much smaller, comprised of much fewer stocks. And like today, it's like all one stock. But just in general, when things get totally bananas above 40, 60, 80, 90, it's almost universally in all the countries been like a pretty dumb idea to be investing. But like I often think about like, let's say we're in Japan and we're hanging out and, we're at 40 and then that sucker just goes up to 50 and 60 and 70 and 80. And this is the trend following. You and I would love that. But at the same time, the value person, anyone who's looking at PE ratio on anything is like, you guys have been wrong, right? Like you've gotten this so wrong. And you're like, well, that's kind of how the PE works, right? As the P goes up and the PE keeps going up. And so I'm writing this article right now about investing in endowments and looking at Yale. And it's funny because I'm trying to make this point where the ending point matters. And when you decide to analyze, so we look at Swenson, 1985 to today, they creamed it like 13, 14% a year, beats everything. However, you take a 60-40 and S&P, it's not far off. In the last 10, 15 years, those in generally are better. And forget about adding a little leverage. Like they destroy some of these best endowments. But then if you look at it from 1985 to 2007, totally different conclusion. And so you have these regimes and you have this challenge. Well, what if this is the peak today and then US stocks go down 50%? You'll come to a different conclusion than if they go from here today, another 4 years up to 60. So many people in our world want certainty of the very short time horizons, and it just doesn't play out that way.
I mean, if you think about even the Fama French paper came out in 92. Since then, growth and value, according to their own factors, are basically the same return. 32 years with no value outperformance. Prior to that, there was, I think the longest period was like 15 years, something like that. But again, so people are saying the value premium is dead. But then again, as you point out, if US equity markets are expensive, the key there is if. If they are, it's probably because the technology companies didn't play out the way people expect, in which case value should outperform from here. And so in 2 years from now, this could be a very different conversation. So I completely agree to your point.
Well, the DeepSeek has kind of come full circle. I was saying for the last couple of years, I was like, I feel like you could play out a scenario. People are always like, what's catalyst? What's catalyst? I'm like, none of us have a crystal ball. Like, why are you even asking this? Like, are we just at happy hour just having fun? Okay, but I'll answer it. But I'm always like, I don't understand why everyone just assumes that the tech AI gains would have to be located in the US. Like most population somewhere else, most of the GDP is somewhere else. Why wouldn't some really brilliant Indian, Chinese, Australian, Brazilian, create some of the next great companies, and then it iterates. And so then you saw this freak out on the DeepSeek, who knows, right? But it seems plausible.
There's a pretty good case that if China became shareholder friendly, again, that's a big if again, that just even given their domestic consumption potential, that they could easily have the biggest companies in the world. Easily. I don't think anybody would argue that. The big challenge, as we pointed out in the beginning of the call, is that they are not shareholder friendly. So can you trust that as an investor? I don't know. I'm not smart enough to make that call.
Which is why shareholder yield works so good there, because you tend to stay out of the serial issuers, the people that are just spending it all on who knows what. It's funny, when we go back to the investing pyramid, what do we know that's true? Some of, my hot takes is like, number one belief in investing, stocks outperform bonds, but there's been periods where that's been not true for decades, right? So like entire careers. But thinking back to a couple of comments you made, value, like whatever happened to everyone used to talk about small cap premium, that is no longer a thing that people believe. Like that is gone. Like people used to, every single Ibbotson, every single chart is like, there's a small cap premium, you invest in small caps, you magically get 2% extra a year. No one believes that anymore. I don't think so. Like I haven't talked to anyone who believes in. The
funny thing is I actually have a pretty sizable allocation to small caps on my personal accounts. And so whenever small caps outperform like the NASDAQ, I make I'll make a joke. And then the small cap proponents come out of the woodwork and say, like, join the finally a day of joy rejoicing. It's a real struggle.
Two quick comments. We'll add this in the show note links. One of the best videos of the year, Professor Damodaran does these amazing free classes, but he basically talks about this, how the value in small cap has essentially been erased from the data post French Fama. He's amazing at everything, but this particular video, we'll put in the show note links. But somebody on Twitter, and we'll have to find out who it was, said that their kid painted the Morningstar style box, when small cap outperforms, it's green and the large growth is red, and gave it to him. And I was like, I would buy one of those. Tell your daughter or whomever it was, like $20, $100, like send me one. I'll frame it and put it in the office. I was like, that's the coolest daughter ever. I feel like they've been so maligned. You give them the one day of outperformance and they come out of the woodwork. Poor Meb and Toby and everyone else. So what is your second most memorable investment since we talked about your first? Anything else come to mind?
This is where I wish I could say it was buying Bitcoin at $200, but I can't because I sold it, I think, at 500.
Hey, man, that's a 1.5 bagger. No, wait, 200, 500.
And I got to mention Sam Lee because he got me into Ethereum at like $8. And I can't say that either because I probably sold it at like $20. So there's a theme that I can't stick with stuff, which is why I love trend following so much. But
the theme is we just got to have like a 13F on tracker on Sam. Like he's quasi-retired now.
Like one of my truisms on here is don't ever, like this is literally on here, do not ever buy any or sell anything based on anything you see on Twitter except if it's from Sam Lee. That's one of my truisms.
He's a big tax follower as well. He was talking about some of these ideas.
I'm going with UPST then. So for 10 plus years, I've wanted to launch something. And so I'll go with that's one of my more memorable ones. But the house that I'm now stuck in the basement for some family reasons, which I won't get into, for my office is definitely number one. I mean, it's been life-changing for the family. And honestly, it's like the 2.5% is the gift that keeps on giving.
I'm surprised none of the three boys has barged in yet.
They're still at school, so.
There we go. Ryan, people want to follow your hot takes. What's the best place? Is it the website?
Yeah, the website's a great place. Aptus blog, APTUS. And if you go space blog on Google, you'll find it. That's probably the easiest way. I'm also on LinkedIn. I tend to kind of repost a lot of my stuff. Over the last year, I've tried to do a little bit more over there, but I got to keep up with that. But yeah, probably on the website.
It's quickly becoming the cool place for the nerds to hang out. So I'll see you over there.
Well, thanks for having me. Anytime.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.